Yes, in our previous class, we were looking at, if you can remember, in our previous class, we were looking at public sector accounting. So we were able to introduce how public sector entities undertake their accounting. And of course, we were able to mention that in this case, when you talk about public sector entities, then these are like government agencies, for example, in this case, ministries. For example, we could be talking about maybe parastatals. We could be talking about, for example, in this case, public schools. So there's a way in this case they'll be able to undertake their accounting, and they're actually guided by the International Public Sector Accounting Standards, IPSAS, by the IPSAS, International Public Sector Accounting Standards. So they follow this particular kind of standards to be able to do what, prepare their books of accounts, so maybe what, financial statements. So that is what we discussed in the previous class. And of course, we looked at, in this case, the benefits of being able to adapt IPSAS. And of course, in this case, what are some of the challenges that in this case will arise in regard to adapting what you're calling what IPSAS? Sometimes you say there can be resistance, maybe in this case by what? By interested parties. For example, in this case, the politicians. So there won't be political goodwill, for example, to adapt what? The IPSAS. And then in this case, for example, sometimes those who end up having to implement this kind of IPSAS, they are different countries. So they are actually different countries. They can be having their own local standards, which, for example, could end up having to conflict what the IPSAS are having to provide. So the adaptation of this kind of IPSAS might end up having to be, for example, be a challenge. So we commenced by looking at a question. We looked at September. The question we looked at previously was actually September 2015. It was question 5B. It was actually question 5B. And through that particular question, we were able to understand how, in this case, you can be able to develop the statement of financial position. And of course, you can be able to come up, in this case, with a statement of financial performance. So we looked at, in this case, how you can come up with a statement of financial performance. So this is what we would refer to, in this case, in our profit making or the other entities, as an income statement. Then also we were able to look at, in this case, the statement of financial position, as the balance sheet financial position. So in our today's class, I was able to indicate, we'll be able to look at now, in this case, how they account with regard to what budgeting, Of course, if you come across this term budget, maybe you might have come across it maybe in management accounting, or maybe in this case in any other area. You'll be told that in this case, this is where, for example, even if it is a profit-making organization, they'll end up having to come up with maybe a budget, maybe at the start of the period or the start of the year. Then in this case, they can end up having to compare with what they have been able to, for example, realize, or what they have been able to spend. When they compare, in this case, for example, the budget, they compare what they have budgeted for. When they compare what they have budgeted for, and of course, the actuals, when they compare with the actuals, then in this case, they're able to get, for example, a variance. And in this regard, with regard to, for example, public sector entities, for example, county governments, each and every year, you'll be told that in this case, there's a budget. So basically, the Cabinet Secretary of Finance is going to, in this case, present the budget statement. So the budget, then of course, in this case, they'll work towards how they can be able to finance this budget. So in this regard, we talk about budget, the budgeted. These are just estimates they are able to come up with in this spend. Maybe they end up having to spend, or maybe realize as well. But along the year, they'll now have the actuals of what they have been able to spend, what they have been able to provide as an. So if you compare what was actually budgeted for, and of course the actuals, it will bring a variance between the two. Therefore, in this case, this variance can end up having to be maybe favorable. It can be favorable, or it can be adverse. It can actually be favorable, or it can be adverse. So it will likely basically be favorable. For example, in this case, if it is working in favor of that public sector entity. We can be able to say, for example, it is working in favor, for example, they estimate maybe with regard to education. With regard to education, they had actually estimated maybe they'll spend how much? Let's say, for example, 3.4 billion. So this was the budgeted. But now, actually, what was actually maybe in this case, what, 3.1 billion. So you can see in this case, probably they ended up having to have a variance here of 0.3. This one will be favorable because they didn't exceed what they had actually budgeted. They didn't exceed what they actually budgeted for. So that is what you're going to look at today. Example, but they end up having to their budgeting accounting, where the comparison had actually been budgeted, the actuals, and of course, yet our variance, would end up having to be a favorable, maybe in this case, what? An adverse, would actually be an adverse. So to be able to comprehend what you are trying to discuss here, then I want us to look at a question. I want us to look at a question. So with regard to budgeting, I want us to look at a question with regard to budgeting. Hope you have your past papers as I had advised earlier. So you are far much better off if you can just be able to print them and be having them when you're having a class. It will be an easy time for you. It will be an easy time for you once you want to use what? The papers. Once we want to use the papers. So in this case, we're going to look at budgeting accounting. Budgeting accounting is under 𝒉𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂𝒂 2024. And the question you're going to look at, it is December. It is December. So you open this question December. The question is December 2013, question number 5, A and B. 2013, question number 5, A and B. So you can open it. So please inform me once you've been able to open it. Inform me once you've been able to open it. Once you've been able to open it, you can inform me. You can inform me once you've been able to open it. So there are past papers which I've even shared today on the group. So you can just open that batch, then go to December 2013, question number 5, A and B. Question number 5, A and B. December 2013, question number 5, A and B. If you've been able to access it, you can inform me whether you've been able to get December 2013, question number 5. In the chat, you can be able to let that we can move together, so that we can move together. So it is on page number, I think 53, page number 53. So let me know whether you've been able to get a question. So because I want us to start we start looking at the question. Have you been able to access the question? Have you been able to access the question? Have you been able to access the question or not yet? I can see Johnson Kilo says yes, he has been able to access the question. What about the rest? What about the rest? I can see David Gitonga says yes. David Gitonga says yes. David Gitonga says yes. What about the rest? Actually, they have to be able to say. Ruben, Mumbi, Mohammed, Masi, Sarah, have you been able to access? It is on page number 53. I think it's page number 53, yes. Page number 53. Page number 53. So you can see Mohammed says yes, he has been able to access. Page number 53, Mumbi. So page number 53. So the question says, part A, with the reference to international public sector accounting standards, that is 𝒐𝒏𝒆, explain 4 benefits that would accrue to your country in adopting 𝒐𝒏𝒆. Then Roman 2, describe 3 challenges your country could face in adopting accrual accounting what practices. Accrual accounting what practices. Accrual accounting what practices. So for these accrual accounting practices are a part of what in this case is actually recommended under what 𝒐𝒏𝒆. Essentially, they're just having to ask you to, for example, explain what are the difficulties or maybe challenges when you adapt what 𝒐𝒏𝒆. And if you can recall, I think we were able to look at it in our previous discussion. If you can recall, in our previous discussion or previous class, we looked at the benefits of adapting 𝒐𝒏𝒆 and, of course, part of the challenges when you adapt what 𝒐𝒏𝒆. So we'll focus on part B. So the following information was obtained from the Ministry of Finance for the fiscal year 30th June 2012. So required, so you can see that we have in this case payments. In this case, we have the required a budget outturn for the Ministry of Finance for the year ended 30th June 2012 in accordance with the requirements of international public sector. 𝒐𝒏𝒆 number 24. 𝒐𝒏𝒆 number 24. Presentation of budget information in the financial statements. Presentation of budget information in the financial statement. So you can see in the first column, we have what was actually budgeted for. And because now in this case also we have what we are calling what the actuals. We have the actual what was actually spent. What was actually spent. So in this case, we'll be able to find out what are, for example, in this case, what the variances. What are the variances? And these variances we are having, as we've been able to indicate, you'll in this case identify whether it is maybe a favorable or an adverse variance. A favorable or an adverse variance. So we can be able to just, in this case, what you do, you can just copy, you're having to see there. You can just copy what you're having to see. So we, whether these variances are favorable, you compare what was budgeted and actually what they realized. What they budgeted for and what they actually realized. So the budgeting accounting, for example, in this case, having to account with regard to the budgets in this case, will present the information as this. So we have the budgeted, we have the budgeted, the budgeted, and we have the actual. So we can have our column like that. So this is the budgeted. And we have the actual. So this is in shillings of millions, shillings of millions, shillings of millions, shillings of millions, shillings of millions. So in this case, we'll be able to identify what was actually the variance. What was actually the variance? What was actually the variance? So so what you can do, we can first of all just copy what you're having to see there. So we have the receipts. We have the receipts. Just copy first of all what you're having to see there. before we go into the variances, So we have the receipts. So the receipts here, we have revenue from taxes, revenue from tax. In this case, they had budgeted to collect 600 million. But in this case, in reality, what they collected was 552 million. Then borrowings, other revenues, other receipts they were expecting, they expected they would borrow. They were expecting they would do some kind of borrowings. So that is from maybe nationally or from in their country, or basically foreign borrowing. So that is 400,000, and was what they actually borrowed was 380,000. So foreign here, foreign 160,000 million. They actually borrowed from the foreign market 320 million. Grants, we have grants. So grants have IMF and World Bank. So from IMF and World Bank, we had budgeted from IMF and World Bank 80 million, but actually what was actually 100 million. They got 100 million. Other government agencies, they were expecting expecting in this case to get 60 million. They were expecting to get 60 million, but they ended up having to get 64 million. They got 64 million. And the payments, what they ended up having to pay out, the payments in this case. So for education, this Ministry for Education, they were expecting in this case to spend 600 million, but they spent how much? 536 million. They ended up having to spend 536 million on defense. They were expecting to spend 120 million, but they spent 80 million. Then on government transition planning. So transition in the governments, they were expecting to spend 10 million on transition, but they spent 115 million. They spent 15 million. Then on health, health, they had budgeted for 201 million, but they ended up having to spend 120 million. Then on housing, they were expecting to spend 180 million, but they ended up having to spend 220 million. Then on internal security, we're expecting to spend 240 million, but they spent 300 million. Then other expenditures, they were expecting in this case to spend 160 million, but they ended up having to spend 240 million. 240 million. So this is basically what they had actually budgeted for, and what you're supposed to get here, it is the variance. From what they had actually budgeted. If you compare with what the actuals. So for example, when you start with the first one here, you can see Revenue from tax, they were expecting to raise how much? 100 million. But they ended up having to raise how much? 552 million. So what is the variance there? The variance, what is the variance there? So they were expecting in this case to spend 600 million, but they actually realized they didn't spending, but they collected how much? 552 million. So the variance here is actually 48 million. So as I've already been able to say that when you talk about a variance having to be favorable, because you're having to say they can either be favorable or they can end up having to be adverse. They can either be favorable or they can end up having to be adverse. So a variance will actually be favorable if it is actually to the advantage. If it is actually to the advantage of what? Over the entity. Of that entity, or maybe what? Public sector entity. So let's say, for example, in this case, they had budgeted they'll collect 600 million, but they collected 520 million. Do you think it was in their favor or it was adverse? Do you think it was in their favor or it was actually adverse? According to you, do you think this one was actually in their favor or it was adverse? I can see T says adverse. I can see T says adverse. I can see Sam says what? Adverse. Adverse. So of course it was actually adverse, because in this case, if you had budgeted, you'd collect a revenue of 600 million, but you collected less, it is not actually in your favor, because you need to get this money. So that the deficit for 48 million, you'll have to look somewhere else. So it is actually what? It is actually adverse. And if it's actually adverse, we normally put it as what? As a negative. As a negative. As a negative. Then in this case, for borrowings, in this case, from the nationally in the country, they were expecting in this case they'll be able to borrow 400 million, and of course in this case they only borrowed how much? 380 million. So the difference here ends up having to be what? 20,000. Is it adverse or favorable? Is it adverse or favorable? Adverse or favorable? Is it adverse or favorable? Is it adverse or favorable? I can see Justin says favorable. Sam says adverse. Sam says adverse. T says adverse. Adverse. Just adverse because, you know, when you talk about, in this case, income or revenue, you are expecting to get 400, but you got less. It is not in your favor. It's not in your favor. It's just like in this case, for example, you could be negotiating for a salary increment with your employer. Then in this case, you are expecting the employer will increase the salary by 40,000, but by how much? 20,000. So what you collect from your employer is less by 20,000. It means that it's not in your favor, because in this case, if you would have given you the 20,000, then you would have been able to do even more at personal level. So it is adverse. It is actually adverse. It is adverse. That will actually be adverse. Then from foreign borrowing, they were expecting, in this case, they'll collect or they'll be able to borrow 160 million, but it exceeded even what their expectations. It ended up having the expectations. By how much? It is 160. It is 160. It is actually 160. So just, is this one favorable or adverse? Justin, is this one favorable or adverse? It is favorable. I can see in this case, you are saying favorable. I can see my sound is not okay. 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 I can see Sam says favorable. Johnson Kialo says favorable. Yeah, it is of course favorable. So you don't put that negative, so it will remain like that. It is 160. Then in this case, grants, they were expecting to get 80 million, but they got what? 100. So it exceeded their expectation by how much? 20 million. So that is basically in their favor. Exactly in their favor. So that one was actually favorable. So you don't actually put a negative. Other government agencies, they were expecting to get 60 million, but they got what? 64 million. So it exceeded their expectations by how much? 4 million. So this one will likely be what? Will be favorable because they were able to get more revenue. They were able to get what? More revenue, more revenue. So when you go to this side of payments, then in this case, the reverse will basically be arguing in the reverse, in the opposite. So for example, in this case, on education, they were expecting in this case to spend 600 million, but they spent how much? 536. So the difference there is actually how much? 64. It is 64 million. Exactly what 64 million. Is this 64 million, is it favorable or adverse? Is it favorable or adverse? Is it in their favor or it is adverse? It is favorable because in this case they spent what? Less. They spent less. Then on defense, they were expecting to spend 120 million, but they spent 80. Yeah, so we can proceed. So so for defense, it was 120 million, but they ended up having to spend 80 million. So they spent less than what they were having to expect. So that basically is a difference of 40 million. which will likely be favorable. Then government transition, they were expecting to spend 10 million, but they ended up having to spend what, 15 million. So there's a difference of how much? 5 million. This 5 million will not be in their favor because they spent more. They actually spent more. Then health, they were expecting to spend 201 million. I think it was 201 million, but they ended up having to spend 120 million. So there's a difference of 81 million, which is actually in their favor, because in this case, they had actually spent what? Less. They had actually spent less. If you look at, in this case, housing, they were supposed to spend 180, but they spent more by 40. So they spent more by 40. It is not in their favor, so it is unfavorable. Then internal security, they were expecting to spend 240 million, but they spent 300. So there's a difference of 60 million, which is not actually in their favor. They spent actually more than what they were expecting to spend. It's not in their favor. So then in this case, other expenditure, they were expecting to spend 160 million, but they spent 240 million. So there is an extra 80 million, which they ended up having to spend, which is not actually in their favor, which is not actually in their favor, is not actually in their favor. So these are basically the variances, the deviations that ended up having to arise. So maybe in this case, they can be able to use the deviations and, for example, find out what could have been the cause, maybe for overspending or under collection of revenue. So that is basically what can be able to tell them whether in this case, they may be utilizing their resources as expected, or they're not actually utilizing the resources as actually expected. So you'll be able to get the difference. You can be able to get the difference. You can get the difference. So first of all, you can get the total here of the receipts. You can get the total of the receipts here. Then, of course, also, you can end up having to get the total of what? Of the expenditure or the payments. So what is the total of the receipts here? Up here, the figure here. The total of the receipts there. The figure for the total of the receipts here. If you add these ones up to here, the total for the receipts 116 what? Million. So 116 million. It is 116 what? Million. What about the total of the payments? The total of the payments? The total of the payments, you are getting how much? The total of the payments. You're getting 0. Should be able to get 0. Yeah, 0 is correct. 0 is correct. So when you get the difference between the two, it will give you the net cash flows. 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 Which in this case, you'll be able to take. You'll be able to take in this case the 116 million there. 116 million there. Then either you can add or maybe you can less this amount. So you can add or maybe less that particular amount there. So eventually, in this case, it comes to a figure of 116 million as the net cash flows. It comes to a figure of 116 million as the net what? Cash flows, as the net cash flows, as the net cash flows. So it is favorable. Exactly what favorable is a favorable variance. Overall, it's a favorable what variance that they ended up having to realize overall when you compare the receipts and actually what payments, the receipts and actually what the payments. So that is basically, in this case, you come up with the budget statement, or in this case, they can do what we call what budgeting accounting as per 𝒖𝒂𝒂𝒂 number 24, as per 𝒖𝒂𝒂𝒂 number 24. So you can attempt an assignment. You can be able to attempt an assignment. So assignment to attempt. Assignment to attempt. Assignment to attempt. It is May 2014. I think it's just almost similar. It's just a similar approach you'll be able to use. It's just a similar approach you'll end up having to use. It is May 2014, question number 5C, I think so. May 2014, question number 5C. Yeah, May 2014, question number 5C. May 2014. Question number 5C. So you can attempt it as an assignment. You can attempt it as an assignment. So it's just the same approach. So you can be able to attempt it. So hope you've been able to get the concept of favorable or adverse. So you have to think through. So for example, in this case, if it happens, you are targeting to get a revenue, but you get less, it is unfavorable. So it is adverse. It is actually adverse. It is unfavorable or it is adverse. But in this case, you are targeting to get a revenue, but you got more. It was exceeding what you are basically expecting to get. It is in your favor. So it is actually what favorable. It is in your. It will not have a negative effect or impact. A negative effect or impact. A negative effect or impact. So I can see T is asking original and final. Original and final. I don't know what you mean by original and final. Original and final. Do we have something in the question as original and final? Oh, I can see you asking in the assignment. In the assignment, let me look at the question. So original budget, and of course, now in this case, what the final, or you ask it, and you'll end up having to use as you do the comparison. So we have the actuals there. You know, in this case, you have the original budget. Then of course, now in this case, you have what the final budget. We have the final budget. So you'll compare the final budget and of course what the actuals. Compare the final budget and the actuals. The final budget and actually what they are. So in this case, what finally in this case they ended up having to have as a budget, what is actually in the final budget. In the final budget. So you compare the final budget and actually the actuals to be able to get what the variances, to be able to get the variances, So we can look at another area. We can start looking at another area. So I want us to start looking at what we call financial statements. Financial statements analysis. So overall, in this case, when you learn about financial reporting or financial accounting, so that in this case, you're having to collect information so that you can use to present in a meaningful manner to help in what decision making. You are collecting financial information to present it in a meaningful manner so that it can be utilized in making what financial decisions or making decisions within what an organization. So before decisions are actually made, these financial statements that have actually been prepared have to be analyzed. They have to be analyzed. So you have to analyze them. So what are they, for example, presenting in a summary? What are they, for example, presenting in a summary? So before they, for example, in this case, they can use them for decision making, there'll be an analysis having to be done, And of course, in this case, through the analysis, it can be the management of an organization. It can be maybe the finance manager, those who are making decisions. They want to use the financial statement, maybe the income statement. Is, for example, the sheet of financial to be able to do what? Make a decision. Maybe to make a decision as to where they can be able to head as an organization. But of course, in this case, before they use them for decision making, they, for example, try to analyze them. So they can do what we call analysis. So these analyses we'll give them, like in this case, a preview picture in a shell or in a summary, overally how the entire, for example, maybe organization is actually performing in different perspectives with regard to what to the financial statement. And then in this case, there can be, for example, in this case, undertaking of what you call what maybe ratio analysis. Because now in this case, through ratio analysis, you can be able to know, for example, how maybe your current assets are performing over what the current liabilities, how you're performing in terms of what maybe profitability. In this case, for example, your fixed assets are able to cover up, or maybe in this case, what the liabilities. How in this case, for example, in this case, how is your performance in terms of your earnings with regard to how in this case you're having to do what maybe your dividends. So these ratios, for example, they can actually be computed. And of course, I know you've already been able to come across them done financial accounting. So those kind of ratios that are normally computed, they actually help, for example, in this case, to do what analysis, analyze. To analyze. For example, you can be able to say, you can, for example, determine what the gross profit margin. So the gross profit margin will, for example, help you compare the gross profit with, for example, in this case, what the sales. How are you performing in terms of your gross profit with regard to the sales? So you come up, in this case, particular percentage of what of the gross profits. But now you'll be told that each the industry is having to operate. There's like a set standard upon which gross profits, then they are performing well. They are performing well. So management can only be able to analyze these financial statements and try to compare and be, for example, how are they actually performing financially, or in this case, how they are performing with regard to maybe, or with the comparison they are actually in. And through this, then of course, they can be able to make decisions what how maybe in this case can they be able to improve on the gross profit margin, the set standard. You'll be told that in this case, for example, if you have a particular kind of a ratio, it is not actually basically within the set standard, then it means that the entity is not actually having to do perform as expected. So that's why in this case, for example, do what we call what analysis in terms of having to do what, be able to make what decisions, to be what decisions. Echo. Is the echo still on? Mumbi saying what's working. Is the voice still breaking? Mumbi, is it still breaking? So when I move to the board is when it starts. Huh? It is okay now. It is okay now. So I don't know what is the issue. I don't know what is the issue. Yeah, so let's hope it won't. Yeah, so we can write something. We can be able to write something about financial statement analysis. We can write something about financial statement analysis. So the problem won't occur again. Hope it won't occur again. Hope it won't occur again. So financial statement analysis. So you can be able to write, you can be able to write, you can be able to write. You can be able to write the financial statements which have been prepared, the financial statements which have been prepared in an organization, the financial statements which have been prepared in an organization, the financial statements which have been prepared in an organization will be utilized for decision making. Financial statements which have been prepared in an organization will be utilized for decision making. Financial statements which have been prepared in an organization will be utilized for decision making. Decision making. Financial statements which have been prepared in an organization. Financial statements which have been prepared in an organization will be utilized for decision making. After having been analyzed by using the following tools, after having been analyzed by using the following tools. So in this case, we can have which tools can you be able to use to analyze? Which tools can you be able to have to use to analyze after having been analyzed using the following tools? So you can write number one. So number one, in this case, you can say ratio analysis. Number two, you can say comparative analysis, or you can say common size. You can say common size analysis. Then of course, now in this case, we have what we call comparative analysis. Comparative analysis. So I can see you are requesting I repeat the introduction of financial statement analysis. So maybe I can be able to repeat. Hope I'm not actually breaking. So I was having to say that in this case, in organizations, of course, you're having to say that in financial accounting or financial reporting, we know that is all about having to do what collects financial information or data. Then in this case, we can be able to present this financial information or maybe data into meaningful information to help in decision making. So we come up with, for example, the income statement. We come up with, for example, in this case, the balance sheet or statement of financial position, or maybe the cash flows. So all these that we prepare as final statements in the organization, they'll help the management, for example, to do make decisions. More so in this case, financial decisions. But you're having to say that before they, for example, utilize them for decision making, they'll have to analyze them. So they'll use this kind of tools, for example, to be able to analyze them. The reason why in this case they have to analyze, in this case, when you look at, for example, in this case, just the balance sheet as the way it is, you look at, for example, in this case, maybe the income statement as the way it is, it would, for example, in this case, help you so much, for example, in this case, to do make a decision. Unless, in this case, for example, you try to analyze it by coming up with, for example, what may be the ratios. So in ratios, for example, in this case, in your financial accounting, you might have been told that in this case, for example, you can come up with a number of ratios. So you have to say, for example, if you come up with profitability ratios, you can be able to, for example, compare the profitability ratios with the set or recommended standard that's supposed to be achieved with such kind of for example, an entity in the industry it is having to operate. Maybe in this case, you'll actually be told that, for example, for a company that is actually in a pharmaceutical industry, that the expected gross profit margin or net profit margin to be achieved by that kind of an entity, the industry standard is normally, let's say, for example, maybe 25%. So when they, for example, compute the profitability ratios, like, for example, it is maybe 80%. It means that they're not actually having meet the target, the expected standard for the industry. It means that as they move forward, they need to make a decision. What could, for example, be not to be able to have a favorable ratio? So that in this case, they have to do them and enable them to make decisions as to what, for example, they can be able to maybe face the future. In this case, they use an tool to do this kind of analysis to enable them to make it. So therefore, in this case, they can use what you are calling analysis statement and the comparative analysis. Those are the ones we're going to look at this case at how they can, for example, analysis. We can start with the ratio analysis. We can start with the ratio analysis. We can start with the ratio analysis. But example, use the ratio analysis. So we'll be able to, before we proceed to computations regarding ratios. So you can say ratios can be categorized into 5 categories as follows. Ratios can be categorized into 5 categories. I.e., ratios can be categorized into 5. Number 1, you can be able to have what we call liquidity ratios. Liquidity ratios. You can have, in this case, profitability ratio. Profitability ratios. Number 3, we can have, in this case, valuation ratios. Then we can be able to have all gearing ratios. Gearing, or in this case, you can call it leverage. Leverage or solvency ratios. Then also we can be able to have the final categorization as activity ratios, which sometimes we can end up having to refer to as what, maybe asset utilization, or maybe you can be able to say maybe turnover ratios. So those are the categories. So we are taking, in this case, liquidity ratios, profitability ratios, valuation ratios, gearing ratios, leverage ratios, or what we call solvency ratios, then activity ratios, asset utilization ratios, or turnover ratios. I can see Gitonga is saying it as began again. Imeanza tena. I hope you've been able to capture them. Have you been able to capture them? Liquidity ratios, profitability ratios, valuation ratios, gearing ratios, activity ratios. So we can start in this case with liquidity ratios. We can start in this case with what? Liquidity ratios. We can start in this case with the liquidity ratios. We can start with the liquidity ratios. Let's start with the liquidity ratios. Liquidity ratios. So liquidity ratios. So these ratios indicate the ability. So they indicate the ability. They indicate the ability of the company to meet its short-term financial obligations. They indicate the ability of the company to meet its short-term obligations. In this case, it says you are liquid. Sometimes you've been told that in this case you are liquid. It means that you have money, so you can be able to meet any short-term obligation as quick as possible. So you have money, you are liquid. So when you talk about liquidity ratios, they indicate the ability of the company to meet its short-term obligations, short-term obligations. So we can look at the first one in this case. So the first one here, number one. So the first one here, number one, is what we call the current ratio. The current ratio. So how this one, you end up having to compute it. So the current ratio, it is equal to the current assets, divided by the current liabilities, So we divide the current assets, divided by the current liabilities, So it indicates the number of times current liabilities can be paid out of what current asset. It indicates the number of times, can be able to write. It indicates the number of times. Current liabilities. It indicates the number of times current liabilities can be. It indicates the number of times current liabilities paid out of the current assets. Number of times current liabilities can be paid out of the current. It indicates the number of times current liabilities can be paid out of the current assets. The recommended is to 1. The recommended ratio is 2 to 1. Your current assets will be 2 times current what lab. That means that if it is cash, current, so that is the recommended. But if it's the other way around, it means that you cannot actually be able to meet your short-term obligations as soon as possible. For example, if you have a short-term loan, you cannot be able to pay it because your current assets you have, which you can easily convert into cash, are not enough for those liabilities. So the ratio here, it should actually be like this: 2 to 1. 2 to 1 will be recommended. Will be the most recommended ratio. Will be the most recommended. So if it is more than 2, the better. More than 2. Always in this case, that you are playing with your working capital so that it can actually be like this. Playing with your working capital so that the ratio can actually be like that. So the ratio here, what we call the quick ratio. Sometimes we call it the acid test ratio. Or what we call the acid test ratio. So in this case, the quick to get the quick ratio, actually current minus assets. Current assets. Assets minus the stock or inventory. The stock current. This one. In this case, this is what? Yes, so why do you have having to less the stock? So that in this case you can come up with the current that you can easily convert to cash as soon as possible. You less the before you sell goods, can take time. You can end up having to stock because you won't be able to convert into cash as soon as possible. Only basically move it and remain with those assets you can easily convert. You remain with that cash at bank. In this case, to cover what the current benefits. So you can be able to write this about the quick ratio. It indicates the ability of the company My sound is wanting. So my sound is wanting. My sound is wanting. My sound is wanting. So let me see what you're going to do. Let me see what you're going to do. Let me see what you're going to do. So just in a minute, you can have a break of like 10 minutes. You can have a break of like 10 minutes. 10 minutes. I'm going to tell you what you're going to do. Hello, hello, hello. Am I still breaking? Is it still breaking or it's a bit better? You can confirm whether it is still breaking or it is a bit better. I can see Mumbi says it is clear. You are good. So let's try and see whether it'll work out. Let's try and see whether it'll work out. Whether it'll work out. Let's try and see whether it'll work out. So I can see you are saying I keep checking the chat. I think the studio I'm working with has a challenge. Maybe next time I'll be able to change the studio because it seems it's the studio. The others are not having a challenge like what I'm having. The other classes going on are not having a challenge. So it seems it's the studio. So I think our friend was telling me to repeat what I was explaining about the quick ratio. So I was having to say that it's just similar to this one, only that you end up having to take out what the stock and you remain with those assets that you'll end up having to convert into cash as soon as possible. So for example, in this case, most probably when you're preparing your balance sheet, you'll in the current assets, mostly you put what? You put cash at bank, you put cash at bank, you put maybe in this case cash at hand, you put also what? Inventory, cash and cash equivalent. So you'll remove stock because stock you cannot actually be able to convert it into cash as soon as possible. So you want to be very quick. You want to be very quick in terms of having what? Cash, so that you can be able to cover up what? For your liabilities. So that's why in this case you'll end up having to remove what? Stock. So as I was explaining, it indicates the ability of the company to meet. It indicates the ability of the company to meet the current liabilities from its most liquid current assets. It indicates the ability of the company to meet its current liabilities from its most liquid current assets. From its most liquid current assets. And of course, I've already been able to say the most liquid current asset, it can be cash, cash at bank, or cash and cash equivalents. So that's where you remove stock. You know, stock can be on the shelf in the shop or in the company for even a year you haven't sold. It is not easy to convert stock into cash. Maybe customers can fail to buy. So what happens? But if you have cash at hand, cash at the bank, that is cash that is readily available to cover up for your liabilities. So the most recommended in this case ratio is actually 1:1. So the most recommended ratio is 1:1. So the most recommended ratio is 1:1. 1:1. So they should be able to match 1:1. 1:1. The most recommended ratio is 1:1. 1:1. Then in this case, you have what you call cash ratio. You have what you call the cash ratio. The cash ratio. Like this, the cash ratio. The cash ratio. So how do you get this one? How do you get this one? Cash ratio. So the cash ratio in this case, you take the cash and cash equivalents. Cash and cash equivalents. You divide by the current liabilities. The cash and cash equivalents, you divide by the current liabilities. Is the cash you have and the asset you can easily convert into cash, only those ones. Only those ones. Then in this case, you compare with what your current liabilities. So you'll get what we are calling the cash ratio. The cash you have and the assets you can easily convert into cash as soon as possible. Maybe in this case, it can be, for example, you have some money in terms of a government bond. You know, in this case, you can easily convert that government bond into into cash. When you, for example, maybe dispose it off. So the cash that you have and the assets that are basically can be categorized as cash equivalents, they're the ones in this case you compare with the current liabilities. The current liabilities. So it indicates, you can be able to write and say, it indicates the ability. It indicates the ability. It indicates the ability. It indicates the ability of the company to meet current liabilities. To meet current liabilities from the cash and cash equivalents. It indicates the ability of the company to meet its current liabilities from the cash and cash equivalents. From the cash and cash equivalents. From the cash and cash equivalents. Cash and cash equivalents. From the cash and cash equivalents. Cash and cash equivalents. Full stop. Then you can be able to say cash equivalents can include, what are cash equivalents? Cash equivalents can include treasury bills. Cash equivalents can include treasury bills. Can include treasury bills or bonds. Can include treasury bills or bonds. Cash equivalents can include treasury bills or bonds. So those ones you can easily convert them into cash as soon as possible. So that's why we refer to them as cash equivalent. So you compare with what you have as cash and compare with the current liabilities. So it will enable you, for example, to be able to know how quick can you actually end up having to, for example, pay up this kind of liabilities in regard to these current liabilities if you compare with what the cash equivalents, maybe the cash you have at hand, then in this case, we can look at another category of ratios. Those are the liquidity. We can look at another category of ratios. So another category of ratios. In this case, you can be able to write valuation ratios. So number 2, valuation ratios. So they are used to determine the value of the company. They are used to determine the value of the company. So the valuation ratios, they are used to determine the value of the company. They are used to determine the value of the company, the value of the company. So I can see Sarah is asking the recommended ratio. So it's not actually recommended ratio for cash ratio because it is not one of the most commonest ratio, for example, that will be used in what analysis? That will be used what in analysis. So the one that in this case will be mostly be preferred when they are doing analysis is the acid test ratio and of course what the current ratio. But the cash ratio is so much common utilized. In this case, there's no actually what recommended ratio. But of course, you can be able to just use it to do what? Maybe compare how enough do you have as cash and cash equivalents to be able to cover for your short-term liabilities. But in this case, overall, when the analysis is having to be done, majorly what will be utilized in this case, it is the current ratio and of course the acid test ratio. The acid test ratio. So the valuation ratios are used to determine the value of the company. So they include number one. So this one is used to know how valuable is the company. So number one, in this case, we have the earnings per share. Earnings per share. So this one here is earnings attributable. So the formula here is earnings attributable to ordinary shareholders. Earnings attributable to ordinary shareholders. Earnings attributable to ordinary shareholders. The number of ordinary shares fully issued and paid over the number of ordinary shares fully issued, number of ordinary shares fully issued and paid, So that's why in this case you get the EPS. So in short, we normally call it what? EPS. So the earnings attributable to ordinary shareholders. So what they're supposed to be able to get, so in this case, you divide by the number of ordinary shares fully issued and actually what paid. So of course, this one, maybe this is what dividends. So because the earnings that are normally distributed to the shareholders is what we call what dividends. So maybe in this case, you can actually be told that the dividends distributed to the shareholders out of the profits was actually very much. So basically the earnings from the profits which they have been able to distribute to the ordinary shareholders. So attributable to ordinary shareholders, there's a repetition here, but you can ignore one of it. So earnings attributable to ordinary shareholders over the number of ordinary shares which have actually been fully paid. So you'll be able to know how much is each and every person having to earn per one share. So because it's over the number of ordinary shares, over the number of ordinary shares. So the ratio indicates the profitability, the profits available. The ratio indicates the profits available to each shareholder. The ratio indicates the profits available to each, not shareholder, but to each share held by an investor. The ratio indicates the profits available to each share held by an investor. To each share held by an investor. The profits available to each share held by an investor. Held by an investor. So overall, in this case, if it happens that the company is able to have a higher EPS or earnings per share, it means that in this case, the investors are having to get their returns. The investors are having to do to get their returns. And therefore, in this case, the company will be so much highly valued. In this case, if it can be able to meet a higher return per share to the shareholders. But if it happens the company is not, for example, meet a higher return to the shareholders, it means that the performance of the company is not actually so well. And therefore, in this case, it won't actually be so highly valued. So in this case, the higher the EPS, it means that the highly valued the company is. The lower the EPS, the company is not actually so much highly valued because it can be able, for example, not be able to provide a return to what? To the investors, Then you have, in this case, dividends per share. 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 So sometimes we refer to it as DPS. So DPS is equal to, in this case, total dividends declared and paid. Total dividends declared and paid. Total dividends declared and paid, you divide by, in this case, the number of ordinary shares. The number of ordinary shares. You divide by the number of ordinary shares. You divide by the number of ordinary shares. You divide by the number of ordinary shares. Alternatively, you can be able to take EPS, you multiply by the dividend payout ratio. The dividend payout ratio. Now, in this case, you can just be able to use what? The total dividends declared and paid, you divide by the number of what? Ordinary shares. So what does it indicate? I can say it indicates this ratio. Actually, when you compute it, it indicates the actual cash received. It indicates the actual cash received by an investor. It indicates the actual cash received by an investor as dividends. It indicates the actual cash received by an investor as dividends for each share held. For each share held. Each share held. It indicates the actual cash received by an investor as dividends for each share held. For each share held. For each share held. For each share held. So the dividends that, in this case, an investor has actually been able to get for each and every share is actually having to hold the company. Then number 3, we have what we call dividends yield. Dividends yield. Dividends yield. Dividends yield. Dividend yield. So number 3, we have what we call what? Dividends yield under valuation ratios. We have the dividends yield, dividends yield, dividends yield. Not dividends yield, but earnings yield. Sorry, earnings yield is supposed to be earnings yield. Earnings yield. Earnings yield. The earnings yield. Earnings yield. So the earnings yield, sometimes we just abbreviate as EY. So it is equals to market price, if earnings per share over the market price per share is equals to the EPS. So the EPS you computed in number 1, you divide by the market price per share, the market price per share, then you multiply by 100%. So earnings per share, you divide by the market price per share. So this one, if you can't remember, you can write in full. So the earnings yield is equals to earnings per share over the market price per share. So EPS is earnings per share. MPS is market price per share. EPS is market price per share. Is market price per share. Alternatively, EPS. So you have EPS. Alternatively, EPS. I don't know what you mean by. So we're having to say that in this case, EPS is meaning earnings per share. One means market price. EPS is market price per share. So EPS is earnings per share. MPS means market price per share. EY is this one, earnings yield. So you can sometimes abbreviate. But now this one you multiply by 100%. You cannot, the other two, we were not multiplying by 100%. But if you're talking about a yield, it's supposed to be in a percentage. So you multiply by 100%. So it will be able to give you the earnings yield, the earnings yield. Then the next one is what we call dividend yield. Dividend yield. So the dividend yield. So number 4, we talk about dividend yield. Or before that, maybe you can be able to explain this particular one. So you can just be able to briefly explain it. It indicates percentage of return. This one, the earnings yield, indicates the percentage of return. It indicates the percentage of return every amount invested in the company. It indicates the percentage of return for every amount invested in the company. For every amount invested in the company. So I can see Mumbi is asking. So just I'll be able to tell you, but let's first of all, I'll be able to tell you, just proceed and write what we are proceeding with. I'll tell you Mumbi. So in this case, it indicates the percentage return for every amount invested in the company. It indicates the percentage return for every amount invested in the company. For every amount invested in the company. Then in this case, we have number 4, dividend yield. Dividend yield. Dividend yield. We have what we call dividend yield. So dividend yield. So dy is equals to what? dy is equals to what? The dividend yield is equals to what? Is equals to dividends per share. Dividends per share, or DPS, over, in this case, the market price per share. You multiply by 100%. So remember, DPS is dividends per share. So if you can't remember, you write it in full. You write it in full. So dividends per share over market price per share. You multiply by 100%. The dividend yield is equals to dividend per share over market price per share, multiply by 100%. If you can't remember, please write it in full. Dividends per share over market price per share. So what is this ratio utilized for? It indicates the percentage of return. It indicates the percentage of return in form of dividends. It indicates the percentage of return in form of dividends. It indicates the percentage of return in form of dividends for every amount. It indicates the percentage of return in form of dividends for every return. For every return. For every return invested in, for every amount, sorry, for every amount invested in the company, for every amount invested in the company. It indicates the percentage of return in form of dividend for every amount invested, for every amount invested in the company, for every amount invested in the company. Then you have, in this case, number 5, what we call the dividend payout ratio. Dividend payout ratio. The dividend payout ratio. So how do you get the dividend payout ratio? The dividend payout ratio. So is equals to dividend per share. Dividend per share. So is equals to dividend per share. Dividend per share. Dividend per share over EPS. Dividend per share over earnings per share. Over earnings per share. Over earnings per share. So is equals to dividend per share over earnings per share. So dividend per share over earnings per share. Dividend per share over earnings per share. Over earnings per share. So what is it actually utilized for? This dividend payout ratio. What is it for? What does it indicate? It indicates the proportion of the earnings. It indicates the proportion of the earnings. It indicates the proportion of the earnings. The proportion of the earnings available to ordinary shareholders. It indicates the proportion of the earnings available to ordinary shareholders. It indicates the proportion of the earnings. Because in this case, you have earnings, refer to them as what maybe retained earnings. It indicates the proportion of the earnings available to ordinary shareholders. it indicates the proportion of the earnings of the company available to ordinary shareholders, available to ordinary shareholders, available to ordinary shareholders. So that is the dividend payout ratios. You take the DPS or dividend per share over the earnings per share, or EPS over the EPS, over the EPS. Then in this case, number six, another ratio under the valuation ratios, we have the dividend cover ratio. Dividend cover ratio. Dividend cover ratio. The dividend cover ratio, then in this case, you reverse this one. So it will be EPS. It will be EPS over DPS. It is the reverse of this one. It's the opposite of that one. So refer to it as what's the dividend cover ratio. So the earnings per share over the dividends per share. You take the earnings per share over the dividends per share. The earnings per share over the dividends per share. So what does it indicate? What does this one indicate? This ratio, what does it actually indicate? Or what is it used for? So it indicates the number of times. It indicates the number of times. It indicates the number of times ordinary dividend. It indicates the number of times ordinary dividend is paid out from. It indicates the number of times ordinary dividend is paid out from. Ordinary dividend is paid out from the earnings available to the ordinary shareholders. The earnings available to the ordinary shareholders. It indicates the number of times ordinary dividend is paid out from the earnings available to ordinary shareholders. The earnings available to ordinary shareholders. The earnings available to ordinary shareholders. So these are basically the earnings per share. So you basically compare with how much you've been able to pay as other dividends. So how much are these earnings able to cover for these particular dividends? So when you get that, then in this case, it will be able to give you the dividend cover ratio, dividend cover ratio. Then the last one, number 7, is the price earnings ratio. Number 7 is the price earnings ratio. Is the price earnings ratio. Is the price earnings ratio, or PE ratio. Physical exercise. Is it physical exercise or PE ratio, or price earnings ratio? Physical exercise ratio. So PE ratio is equals to, PE ratio is equals to, in this case, the PE ratio is equals to, in this case, the PE ratio is equals, in this case, the market price per share, the market price per share over, in this case, the earnings per share, the earnings per share, the earnings per share. So you take the P, the price per share, over the earnings per share. So PE ratio, price per share, the market price per share over the earnings per share. It will give you the PE ratio, the PE ratio. So what does it show? Why would you, for example, compute this kind of a ratio? Why would you, for example, compute this kind of a ratio? So you can be able to indicate, it shows the relationship between market price per share. It shows the relationship between market price per share and the earnings per share. It shows the relationship between market price per share and earnings per share. It shows the relationship between market price per share and earnings per share. Earnings per share and earnings per share and earnings per share and earnings per share. So there's one that in this case we were having to go through the other one, that it was actually EPS. So Mumbi was asking about EPS, the alternative formula for EPS. The alternative formula for EPS. Is it EPS or DPS? It is actually DPS. So the alternative formula for DPS would be the formula for DPS. DPS give you. And also you can be able to, in this case, get the DPS by taking the EPS or earnings per share. You multiply by, in this case, the dividend payout ratio. You multiply by the dividend. You multiply by the dividends payout, dividend payout ratio. Take the earnings per share. You multiply by the dividend payout ratio. You can be able to see it is here. Now, is it cross multiplication? So what we are told in mathematics, it is, you can see the dividend payout ratio is here. So you do what you call cross multiplication. You multiply by this one, so you'll get, you can remember that kind of math in mathematics. So the dividend payout ratio is here. So this is the alternative, Mumbi. So Mumbi you've been able to get. So I wanted us to first of all go through this one, then we can be able to connect. So this is the alternative formula for DPS. And of course, you can be able to derive it from this formula. So you do the cross multiplication, your DPS will be equal to EPS. EPS, you multiply by this one. You multiply by this one. So that is basically how, in this case, you can alternatively get what you're calling the DPS. The DPS. So those are some of the ratios that, in this case, for example, you can be able to utilize in terms of having to get what's the evaluation ratios. We can look at another class. So apart from 9, in this case, the liquidity, and of course, 9 in this case, what you're calling the evaluation ratios. We also have in this case what you call profitability ratios. Profitability ratios. Those are very easy. You have gross profit margin, net profit margin. So these are the ones that we've been able to do evaluation. They are the ones you have to be very keen about the formula. You are likely to forget the formula very easily. Just remember the formula. So in this case, you have the profitability. And we are talking about what profitability ratios. Profitability ratios. So profitability ratios, you can be able to go to those ones. These ones. These ratios indicate. Voice. Don't know whether it is back. Is it back? Is it back or not yet? Is it back? I can see you're saying voice. Is it back or not yet? It is back. So you can indicate, hope you've been able to write this one. So it is the third category we are looking at. So you can indicate, these ratios indicate the ability of the company. These ratios indicate the ability of the company to generate returns. These ratios indicate the ability of the company to generate returns. These ratios indicate the ability of the company to generate returns in relation to generate returns in relation to investments, and sales, in relation to investment 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 and sales. Full stop. They include, so number one, you can start with gross profit margin. Number one, you can start with gross profit margin ratio. Gross profit margin. So this one is equals to GP over the sales multiplied by 100%. The gross profit margin is equals to GP, or gross profit over sales multiplied by 100%. Then in this case, you have the net profit margin. Net profit margin is equals to net profits over the sales multiplied by 100%. multiplied by 100%. You're able to get the net profit margin. Net profit margin. So that's how you get it. Then operating profit margins, what we call operating profit margins. These are the another ratio, the operating profit margin ratio. So this one you'd end up having to take the earnings before interest and tax, earnings before or EBIT, earnings before interest and tax, earnings before interest and tax. You divide by the sales. You divide by the sales, you multiply by 100%. So you get the operating profit margin. Operating profit margin. So earnings before, in this case, you get, for example, you remove earnings before, in this case, you remove interest and tax. You divide them by the sales. You divide them by the sales. You multiply, in this case, by what? By 100%. By 100%. By 100%. By 100%. By 100%. By 100%. Then we can be able to have, in this case, number 4, return on investment. Return on investment. Return on investment. Return. What are you getting as a return on the investment you've been able to make? Return on investment. Return on investment. But sometimes they can be able to say return on total assets. Return on total assets. What is the return you are getting on your total assets? So this one, you'll take the net profits over the total assets. Is equals to the net profit over the total assets. Then in this case, you multiply by 100%. You multiply by 100%. So sometimes in this case, this net profit, you can be able to say earnings after tax. Earnings after tax. So you can say the net profit or earnings after tax. Earnings after tax. So that's why in this case, this kind of earnings we are having here is earnings before interest and tax. But this one is earnings after tax. You can say net profit, or you can say earnings after you've been able to, for example, eliminate what tax is when you get what the net profit. Or you can just be able to say net profit over the total what asset. So alternatively, here we would have been able to say maybe earnings after tax over sales, or net profit over sales. Alternatively, you can also say EAT, earnings after tax over sales. So you can just say over net profit over what? Over the total assets. Net profit or earnings after tax over the total assets. So in terms of how much you've been able to invest in assets, are you generating, for example, enough what profit? It means that if you have enough or adequate assets, they should be able to enable you to generate more what profit, because you have what enough resources in terms of what assets. So the more assets you have in this case, the more you should be able to do what utilize them to generate more profit. You can compare, for example, in this case, in terms of what you are making as a profit and the total assets you have. So are they, for example, this is enabling you, for example, to generate what's more net profits. So it indicates the percentage. Maybe you can just go right briefly about this one, return on investment or return on total assets. It indicates the percentage of return. It indicates the percentage of return from the utilization of what? Of total assets. It indicates the percentage of return from the utilization of what? Total assets. It indicates the percentage of return from the utilization of what? Of total assets. Of total assets. Then number 5, we have in this case return on equity. Number 5, it is return on equity. Return on equity. Return on equity is actually return on equity. Return on equity. So in this case, ROE, we call it ROE. ROE is equal to return on equity is equal to, in this case, net profits over equity. Net profits. We've been able to say, you can say earnings after tax over the equity multiplied by 100%. Remember, this is we talk about equity here, is what has been put in as what as capital. It can include ordinary share capital and maybe permanent what share capital. So that constitutes what the equity of the company. So you compare your net profit with that equity. What you've been able to put in as capital, is it enabling you, for example, to generate enough what profit? So you can do it to know whether I'm putting in more capital, but is it actually really enabling me to generate much profit? If I compare the profits I'm making and the much capital being able to put into this company, is it actually, for example, in this case, enabling us to get more earnings after tax, more earnings after tax? So you can briefly just write something briefly about the return on equity, just indicator. It indicates the percentage return. It indicates the percentage return. It indicates the percentage return of the company from utilization of the equity holders' funds. From the utilization of the equity holders' funds, or you can say the shareholders' funds or equity holders' funds. From the utilization of the equity holders' holders' funds. From the equity holders' funds. Then in this case, we have the last one, number 6, ROCE. ROCE, or referred to it as what? Return on net assets or return on capital employed. Return on net assets. Return on net assets or return on capital employed. Return on capital employed. Return on capital employed. In this case, we'll be able to say ROCE. Return on capital employed is equal to ROCE, or return on capital employed is equal to net profits. Net profits, return on capital employed is equal to net profits, which you've said you can also be able to refer to as what? Earnings after tax. Net profits over the net assets. The net assets. Or in this case, you say what? The capital over the capital employed. Over the capital employed. Over the capital employed. So the net assets employed over the capital employed. Then you multiply by 100%. By 100%. So the net assets here, you will take the total asset minus the liability. So when you take the total assets, you minus the liabilities, you get the capital employed. So once you do that, then you take net profit and divide by that. You'll be able to get the ROCE. So the capital employed or the net asset, you take total assets minus the liabilities. In this case, eventually, you'll be able to get what? You'll be able to get the capital employed, or what you are referring to as what? As the net asset. Then you can be able to do what? In this case, get what? The ROCE. The ROCE, or the return on what? Capital employed. The return on capital employed. Adjust the board. Yeah, so adjust the board. So ROCE is equals to net profits, or you've been able to say, you can say EAT. This net profit. Sometimes when you look at the income statement, they would have given you EAT. So it means you use EAT as what? As the net profit. So then EAT over the net assets over the capital employed. We are going to say the net assets, you take the total assets, you minus what the liabilities, you'll be able to get, in this case, the net assets of what we're defining for as what? As the capital employed. So I leave a brief assignment. You can look at it, but that is what you'll be able to pick up from. I can give you like 2 questions. You can be able to just be looking at them, but that is what you'll be able to pick up from. Then you'll be able to understand how you can end up having to come up with what. But let me leave this one. You can look at this question. It was tested in December 2022. December 2022. December 2022. Question 4. December 2022. Question 4. December 2022, question 4. So December, now in this case, question you can be looking at December 2022, question 4. But I will go through the other remaining 2 categorizations of ratios. And I think you'll be able to look at this one as part of the sample questions you'll be able to look at. And I think you can be able to start looking at analysis. You can start looking at common size statements, common size statements, common size statements, common size statements. But of course, you can just look at another question. Is the one you'll be able to look at as a guarding rate. Guarding rate. Look at this one as you prepare to this class with that ratios, then you can look at these illustrations. Then it will start looking at next slide. So my volume has really been down. So you've really struggled. So apologies for that. So I think next time, so maybe I'll use another studio. I'll use another studio. So I've gotten your complaint. Yeah, so let's end there. So I'll use another studio. As I'm having to say, I think I can see you people have really struggled. But hope you've been able to write something. As I was writing on the board, so that you haven't gone blank in everything. But I think it's because of the studio I'm having to use. So I'm having to say I'll be able to change maybe the studio. So you'll get a far much better studio for the FR class. So thank you very much. And you people enjoy the weekend. So let's catch up in the next class. Let's catch up in the next class. I can see Johnson Kiali is asking, you use, in this case, the actual budget. You say in this case, use the actual budget. So there are 2 budgets there, but in this case, use what? The actual budget with the actuals. So the actual budget with the actuals. You compare the 2, then you can be able to get what? The variances. You can get the variances. Otherwise, thank you very much. So enjoy your weekend.